There is a specific kind of silence that falls over a trading floor right before something breaks. Not the silence of a slow day, not the silence of boredom. It is the silence of people who have just looked at the same number at the same moment and realized simultaneously that the model they were running 30 seconds ago no longer applies. I've been watching markets long enough to know that silence, and right now, in February 2026, that silence is everywhere. It is in the options pricing, it is in the credit spreads, it is in the way institutional desks are rotating out of positions they held for 18 months without a single public statement explaining why. Something is moving beneath the surface, and the question that almost nobody in mainstream financial media is asking clearly enough is this: is it moving on its own, or is someone pushing it? Let me tell you what I think is actually happening, because the explanation that most analysts are reaching for, volatility, uncertainty, macro headwinds, is technically accurate and almost completely useless. Yes, there is volatility. Yes, there is uncertainty. But volatility does not explain the specific pattern of what is falling, when it is falling, and what is being said publicly in the hours before it falls. For that, you need a different framework. And the framework I want to offer you today is not comfortable. It is, however, the one that makes the most sense of everything we are currently watching unfold in real time. Trump raised global tariffs from 10 to 15%. The timing of that decision was not random. It came within days of a Supreme Court ruling that placed constitutional limits on the scope of executive tariff authority, a ruling that the markets had already priced in as a ceiling on trade war escalation. When that ceiling appeared, equity markets did something interesting. They rose, not dramatically but meaningfully, because the institutional consensus in that moment was that the worst-case scenario had just been legally constrained, and then, within 72 hours, the tariffs went up anyway, through a different mechanism, under a different legal authority, and suddenly the ceiling that everyone had been pricing in was gone, replaced by a question that is far more destabilizing than any specific tariff number. If legal constraints do not actually constrain, what does? Here is where it gets important. And I want you to think carefully about what I'm about to say, because it runs counter to the narrative you'll hear from almost every financial commentator on television today. The drop in equity markets that followed the tariff escalation is not being driven primarily by the economic impact of 15% tariffs. 15% tariffs are painful. They raise costs. They compress margins. They are not, on their own, sufficient to justify the scale of what we are seeing in the sell-off. What is driving the sell-off is something more fundamental: the recalibration of political risk as a permanent variable in asset pricing. For most of the last 4 decades, sophisticated investors treated American political risk as bounded. The system had checks. The courts enforced them. The Federal Reserve was independent. The trade regime was rule-based. You could model around political noise because the structural framework was reliable. That assumption is now being stress-tested in a way it has not been stress-tested in living institutional memory. And when foundational assumptions break, markets do not just price in the immediate change, they reprice everything that was built on top of that assumption. That is what $800 billion evaporating in a single session actually means. It is not a reaction to a policy. It is a revaluation of the entire risk architecture. Now, I want to talk about the artificial intelligence dimension of this, because it is inseparable from what is happening in markets right now. And most people are treating it as a separate story. It is not a separate story. It is the same story, running in parallel, feeding back into itself in ways that are accelerating the pressure on equities. across the board. Here is the sequence. First came the euphoria. I was going to transform everything, make every company more productive, generate new revenue streams, compress costs, expand margins. The market priced this in aggressively. Software companies, cloud infrastructure companies, enterprise technology companies, all of them traded at valuations that embedded significant AI-driven growth assumptions. Then came the disruption narrative. And this is where the market began to do something that, if you watch it carefully, is almost philosophically interesting. It began pricing in the disruption that AI causes to the very companies that were supposed to benefit from AI adoption. Because if AI genuinely works, if it genuinely makes businesses dramatically more efficient, then it does not just create value for the companies deploying it. It destroys value for the companies whose services those businesses no longer need. Think about what happened with IBM. For years, IBM survived on a very specific and very defensible moat: the knowledge required to maintain legacy COBOL-based systems, 95% of ATM transactions, the core banking infrastructure of institutions that process trillions of dollars annually, government systems, airline reservation platforms, all of it running on architecture that was built by people who retired decades ago, maintained by a shrinking pool of specialists, and nearly impossible to migrate without catastrophic operational risk. IBM knew this. IBM charged accordingly. And when an AI system demonstrated the ability to read, interpret, and modernize COBOL code with a level of competence that previously required those rare human specialists, the market did not celebrate IBM's new competitive advantage. It recognized almost instantly that the moat had been bridged, that the thing which had kept IBM relevant was now accessible to any organization willing to pay for an API call. The stock moved accordingly. The largest single-day drop since the year 2000. What does that tell you? It tells you that the market is now doing something it has not done seriously in the AI cycle until very recently. It is pricing the disruption, not just the opportunity. It is asking which companies exist primarily because of inefficiencies that AI eliminates. It is asking which revenue streams are, at their core, attacks on complexity, and whether that complexity can now be automated away. And the answers it is arriving at are not confined to legacy technology companies. They extend into financial services, into professional services, into any sector where the business model depends on the scarcity of specialized knowledge. I want to stop here for a moment and ask you directly, in your view, is the AI disruption we are seeing in markets right now a short-term panic that will correct, or is this the beginning of a structural repricing that will take years to fully absorb? Write your answer in the comments below. I am genuinely curious what people watching this are thinking, because the range of views on this question is wider right now than on almost any other market question I can think of. Let me bring you back to Trump for a moment, because the political and the technological are not two separate forces applying pressure to markets from opposite directions. They are interacting. Consider the position that major US technology companies are currently in. On one side, they are facing an AI disruption narrative that is compressing their equity valuations and raising existential questions about their business models. On the other side, they are operating in a tariff environment that is raising their hardware costs, complicating their global supply chains, and introducing regulatory unpredictability into markets where they generate significant revenue. These companies made public investment commitments. They flew to Washington. They stood in front of cameras and announced billions of dollars in domestic investment to demonstrate alignment with the administration's reindustrialization agenda. Those commitments were made in a specific policy environment. That environment has now changed. And when Trump writes, "Buyer beware," in a public post directed at foreign nations that made investment pledges contingent on a particular trade architecture, the message is not subtle. The deals that were made are no longer guaranteed by the framework that produced them. The approval ratings tell their own story. 60% disapproval is not a number that is easy to govern around. But what is more interesting than the headline number is the composition of what is driving it. Independent voters, historically, the group that determines the margin in every consequential American election, are not enthusiastic. Latino voters, who were supposed to represent a durable expansion of the coalition, are pulling back, and the specific grievance that keeps surfacing in polling is not abstract. It is the grocery store, it is the monthly budget, it is the gap between the macroeconomic narrative being promoted from the podium and the lived arithmetic of household finances. Trump's response to falling approval numbers has historically followed a recognizable pattern: escalation. When the numbers get worse, the actions get larger. When the actions get larger, the uncertainty premium in markets goes up. When the uncertainty premium goes up, the numbers get worse. This is not a cycle that self-corrects quickly. There is also an Iran dimension to this that deserves more attention than it is currently getting in financial media. Military assets are being positioned, rhetoric is being escalated, hawks inside the administration want pressure and confrontation. The negotiators, Kushner, Witkoff, want a deal. The Pentagon is reportedly cautioning against any assumption of a quick, clean outcome. The former National Security Advisor, who knows this president's decision-making style as well as anyone alive, has characterized it plainly. There is pressure being applied without a defined end state. There is no strategy for what happens after the initial move. There is a hope that escalation produces concessions. That hope may or may not be realized. What is certain is that a military escalation involving Iran, even a limited one, would not land in a vacuum. It would land in a market environment already pricing elevated political risk, elevated AI disruption risk, and elevated tariff uncertainty. The compounding effect of those inputs arriving simultaneously is not linear. It is exponential. Here is a question I want to put directly to you, and I want you to think about it seriously before you answer. If the three largest sources of market uncertainty right now, the tariff regime, the AI disruption cycle, and geopolitical risk in the Middle East, all intensify at the same time over the next 48 hours, what do you think happens to the S&P 500 by end of week? Write your number or your directional view in the comments. Let's see what this audience is actually thinking. Now, let me tell you what I think is the most underreported aspect of this entire situation. It is not the tariffs. It is not the AI sell-off. It is the feedback loop between the two and the way that feedback loop interacts with the consumer economy. The United States runs on consumption. 70% of GDP, give or take, is consumer spending. That consumer economy was already showing stress before this month. Retail credit delinquencies were trending up. Savings rates were compressing. The lower and middle quintils of the income distribution were already operating on tighter margins than at any point in the post-pandemic period. Now, layer on top of that the inflationary pressure from tariffs, which are, whatever the political framing suggests, a cost that eventually lands on the end consumer. And you get a squeeze from two directions simultaneously. Prices go up because of tariffs. Real wages do not keep pace because of AI-driven productivity gains that benefit capital rather than labor. Consumption slows. Revenue guidance gets revised down. Equities sell off. Companies respond by accelerating automation to protect margins, which displaces more workers, which compresses consumption further. The academic label for this dynamic is a demand destruction spiral. The lived experience of it, for most people, is that everything costs more, and nothing seems to get better, regardless of what the headline numbers say. The Costco and Walmart valuation situation is worth sitting with for a moment, and these are companies that trade at multiples, which would have seemed absurd 5 years ago for traditional brick-and-mortar retail. They are priced as if the American consumer will continue spending at current rates indefinitely. The market is simultaneously selling off technology equities on the thesis that AI disruption will reduce employment and compress incomes, and maintaining premium valuations for consumer discretionary retailers whose business model depends entirely on those same employed income-earning consumers continuing to show up and spend. Those two positions are not logically compatible. One of them will have to adjust. And historically, when contradictions of this scale resolve in equity markets, they do not resolve gradually. The cryptocurrency parallel deserves mention here. Bitcoin's weekly RSI is at levels that technically constitute oversold territory by conventional metrics. Michael Saylor's strategy has moved from sitting on $33 billion in unrealized gains to sitting on $11 billion in unrealized losses. The correlation between software equity performance and Bitcoin has been remarkably tight through this cycle, which makes a certain kind of sense if you understand both as expressions of the same underlying thesis, that the digital economy will expand indefinitely, that liquidity will remain available to support speculative positions, and that the regulatory environment will remain permissive. Each of those assumptions is now under pressure simultaneously. And in crypto, unlike in traditional equities, there are no circuit breakers. There is no Fed put. There is no backstop. When it moves without the institutional guardrails that at least slow the velocity of moves in regulated markets. What I want you to take away from all of this is not a prediction. I am not here to tell you that the market will be down 20% by Friday, or that we are entering a recession, or that Trump's tariff strategy will definitively fail. What I want you to take away is a framework for thinking about the current moment that is more precise than there is uncertainty. The uncertainty is structural. It is operating across multiple systems simultaneously. It is being partially engineered by political actors who have specific incentives for the short-term direction of asset prices. And it is intersecting with a technological disruption cycle that is generating genuine, non-trivial questions about the future earnings capacity of a large portion of the companies that make up the major indices. The Trump visit to China that is reportedly being discussed for late March is one of the few genuinely constructive data points in this entire picture. Both economies have enough exposure to the current trajectory to make a negotiated de-escalation rational for both sides. China's equity markets have already begun to reflect the calculus that constrained American tariff authority creates an opening. The dollar is at a multi-year low against the yuan, which tells you something about how global capital is positioning relative to the relative strength of those two economies right now. The gap between the political narrative and the market reality is as wide as it has been at any point in this administration. And the interesting question, not the dramatic question, the actually important question, is not whether that gap closes. It is which direction it closes from. Does the political narrative adjust to match the market reality? Or does the market reality eventually force a political response that creates a new set of distortions? Based on the behavioral pattern we have observed over the past 14 months, I think you already know the answer. But it is worth watching very carefully over the next 48 hours, because the decisions being made in that window will tell us a great deal about which path we're actually on. One final thing before I close today. Wherever in the world you're watching this from right now, whether you're in Europe, looking at this as an external shock to your own economy, whether you're in Asia, watching the dollar weaken and drawing your own conclusions, or whether you're in the United States, living inside this in real time, write it in the comments. Tell me where you are and tell me how this looks from where you're sitting, because this is genuinely a global story, and the view from different parts of the world is not the same view. The American financial media covers this as an American story. It is not. It is a story about what happens when the anchor of the global financial system begins to behave in ways that the rest of the system was not designed to accommodate. That story does not have a clean ending written yet, and the next 48 hours will be one of the more consequential chapters in determining how it does eventually end.